This is a paper called The Enhancement of Equity Portfolio Performance Using Data Envelopment Analysis. It's written by Pätäri and others from the Lapinrata University of Technology in Finland. It's published in the European Journal of Operational Research in February 2012. Alright, let's jump into it. So the authors start out with a summary of the past research regarding value and momentum strategies. In particular, all these guys have found price momentum to be a part of stock returns, and also all of these guys have found the value premium in stock return. There are a lot of contradictions between value stocks and momentum stocks. For example, momentum stocks are past winners, whereas value stocks are typically past losers. Momentum stocks tend to perform best over short-term holding periods, while value stocks tend to do better over longer holding periods. So then the question is there a way to combine value stocks with momentum to make a good portfolio? Previous researchers have done this and found that a good way to earn uncorrelated returns, whereas value and momentum are uncorrelated, so then their risk-adjusted returns are a lot higher. But the problem is, how do you combine the value indicator and the momentum indicator into a single selection criteria to form a single portfolio? So the authors in this paper try to solve that dilemma by using data envelopment analysis, which may be the first time that this has ever been done. They've used the DEA in the past to find undervalued stocks, but they've never combined them with momentum indicators until now. In the past, only the stock price was used in their studies, but now they've incorporated the enterprise value as well as EBITDA into their studies and complementary the EBITDA to enterprise value ratio. They note that using the enterprise value may be a useful tactic because the typical use of the price earnings ratio does not incorporate the debt aspect and maybe the financial health of the organization related to the debt. In Section 2, they're going to review the literature related to value investing and momentum investing and their combination. In Section 3, they'll describe the data and the methodology that they employed. In Section 4, they'll discuss the results. And then in Section 5, they're going to make suggestions for future research. So let's jump into the literature review in Section 2. So in the past, the value premium has become a well-known phenomenon across all markets, especially by studies done by Fama and French, and then others subsequent to them. But interestingly, as they've studied those markets over time, they've found that different markets have different criteria about which value criteria performs best, whether it's book to price, cash flow to price, earnings to price, or the dividend yield. These different metrics perform differently over different time periods as well. And the current authors found in previous papers that it's best to use value criteria in conjunction with other different criteria when selecting stocks. And the interaction between value and momentum hasn't been particularly well studied, but it's noted to have first started maybe in 1997, where they found that value and momentum stocks are negatively correlated, which makes sense. And then Bird and Whitaker found that the best strategy is to buy value loser stocks. That's stocks that have not performed very well in the past 6 months, but that have the highest book to price ratios. The thought is that they are very cheap according to their book to price ratio, but also have not performed very well in the past and are looking to turn around. Later on, it was found that value winner stocks perform the best over the stock market and over value loser stocks when sales to price is a value indicator. So the strategy here would be that value stocks may be undervalued for a really long time, so maybe incorporating a momentum indicator would allow the investor to not buy those stocks too early. So the authors here incorporate those the momentum and the value indicators into a DEA strategy to find the best portfolio. So let's jump into the third section on data and methodology. So the stocks the authors use in their analysis are from the Helsinki Stock Exchange over the 94 to 2010 period. The authors note that the Finnish stock market is a little more volatile than other markets during both bullish and bearish times. As a result, it may be easier to have abnormal profits than other markets as a result of this volatility. Importantly, the stocks used avoid survivorship bias. They also adjust for dividend splits and capitalization issues, and erroneous indicators like negative price-to-book ratios are excluded. And the final sample size ranges from 56 companies in May of 1994 to 126 in May of 2008. This includes all non-financial companies on the OMX Helsinki main list. So the authors used the DEA tactic for their portfolio formation criteria, originally proposed by a couple of authors here. These authors abbreviate as CCR. So what it does is it combines a lot of different inputs and outputs and puts it into a single score. So the authors take all the stocks and create an efficiency score annually under three different models. The CCR model and the super efficiency model, introduced by Anderson and Peterson in '93, and the cross efficiency, the CE model, introduced by Sexton et al. In 1986. So then with each of those three models, they create quantile portfolios based on the ranking of the scores. Interestingly, the first two models ended up performing identically. So the results of the CCR model are the same as those for the super efficiency model. So this results in 8 different variants of portfolios. This is due to their using 4 combinations of input and output variables using 3 variants of the DE models. However, since the CCR and the super efficiency models are the same, we can exclude 4 from those 12 to make 8 different portfolios. So the 4 combinations that they're using are the stock price and enterprise value per share, book value per share, the dividend per share, and the EBITDA per share. These are basically the value criteria. The second combination includes all these value criteria plus a momentum indicator. This momentum output variable is the stock price on the first day of May multiplied by its past 6-month return. So the third combination is different because it only includes the stock price as an input variable. The fourth combination is similar to the third, except that they use earnings per share instead of the EBITDA per share. So with these variables, the DEA efficiency score is calculated at every rebalancing date, which is the first day of May, at an annual frequency. So let's get into section 3.3 to test the procedures for the performance comparisons. Okay, so importantly, with the 3 quantile portfolios, they equal weight each of the portfolios. So each of the stocks in them has an equal weight. And they calculate the monthly returns, but they only rebalance once a year. And if a stock is delisted, they put those cash flows from that stock into the portfolio in the new combination. So they evaluate each of these quantile portfolios using their return, Sharpe ratio, skewness, kurtosis, and the 2-factor alpha. And to avoid erroneous results such as negative Sharpe ratios, they use a modified Sharpe ratio where they're using average monthly returns and average risk-free rate over the standard deviation. And they also note some of the criticisms of the Sharpe ratio, for instance, that you're dinged for having high positive returns. And so there are a lot of other alternative measures for determining risk-adjusted return, one of which is the SKASR. And this is the skewness and kurtosis adjusted Sharpe ratio. The calculation of this indicator is beyond the scope of this video, but we should just know that it's a way to determine a risk-adjusted return that we can compare across different portfolios. And so for an additional metric, we want to find out whether this value premium is actually the cause of the returns, or whether there's something else that is causing the returns. So we're going to use a two-factor alpha model to incorporate size as well as the market return to see if those are actually the things that are causing the returns and not necessarily the value or the momentum. As is used in prior papers, the size will be the small minus the big companies, whereas smaller stocks should return more due to their risk. And then as commonly used, the stock market return less the risk-free rate to see if it's just the stock market's return that's causing the return of the portfolios. The authors note that the regression is somewhat simple compared to other tests, but there's the reader should know that there's a conflict between whether small cap stocks drive the value premium or whether they do not. Okay, so in section 3.4, they discuss the statistical tests and adjustments. So the authors note that the way they determine if Sharpe ratios are significant is with the p-values of the Ledoy-Wolf test. It's basically just a way to determine, when comparing two Sharpe ratios, whether they're significantly different or whether they actually could just be the same. And as is commonly done, they use t-statistics to determine if the variables are significant. And they use the Newey-West standard errors to avoid autocorrelation and heteroscedasticity. And they note that the data can be considered to be normally distributed. And they also find that there is not an issue with multicollinearity. Okay, so let's get into the results. Okay, so table 1 starts out with some of the results. You can see over here there's the different portfolios as discussed before, using the CCR approach, the CE approach, and the difference in 1, 2, 3, and 4 according to the inputs and the outputs as discussed before. And also you can see that the DEA rankings are put into 3 quantiles. And in each of these cases, they show the average annual return, the annual volatility, as well as the SCAD, and the Sharpe ratio. And the Sharpe ratio that's adjusted for kurtosis and skewness. In particular, you'll notice that the first portfolio outperforms the third portfolio in every single one of the different formation criteria selections, 16, -8, so on and so forth. And not only just on the nominal return, but also on the Sharpe ratio and the adjusted Sharpe ratios. It's noted that the second CCR portfolio formation criteria has the largest difference, where 17.69 average return exceeds 6.7 for the lowest portfolio. You can note that the inputs and outputs are the most number of variables compared to the other portfolio formation criteria. Also importantly, the average stock market return over that period was about 9.84%. So the return of this first quantile portfolio nearly doubles the return of the average stock market. Also of note, this portfolio significantly outperforms all the others on a risk-adjusted basis as well, with the Sharpe ratio and the adjusted Sharpe ratio compared to all the other portfolios. but the difference between each of the top quantile portfolios isn't that much different across all of the different formation criteria. However, there is a clear difference between the top portfolio and the bottom portfolio in each of the criteria. And looking at the significance columns here, comparing portfolio 1 to 3 and 1 to 2, you can see that the differences between those portfolios is significant on the first three criteria for sure, at the 5% significance level, regardless of whether it's CE or the CCR criteria. However, the difference between the second portfolio and the third isn't as significant as the 1 versus 3 and 1 versus 2. Next, we go to Table 2, which incorporates the size factors as well as the market return factors to determine if those are the cause of the returns. So what we have here is same table as before, but we have the alpha variable, the market beta, and the beta for the small minus big. What we want to determine is whether each of these betas is significantly different from 0 using these significance figures. And if these variables are significantly different from 0, we could say that it somewhat causes the return. So first we can note that the difference between the returns of portfolio 1 versus portfolio 3 are significantly different at the 1% level for 5 of them. So this one, this one, this one, this one, and this one. And it's significantly different at the 5% level for the remaining. And the spread is significantly different at the 5% level across a few of them. However, the spread between the second and third one is not very significant. And also you can note that the small minus big, the size factor, is highly significant across every one of the portfolios. And interestingly, the stock market betas are decreasing as the size of the company goes up. This is in line with Fama and French studies that find that value stocks, which would be in this first portfolio, have lower betas than growth stocks, which would be in this third portfolio. And also of note, by adding the momentum factor into the inputs and outputs, it doesn't significantly increase the return of the portfolios. And in fact, the increase is somewhat matched by the volatility, so it has a negligible effect on the risk-adjusted return. However, it is noted that the addition of the momentum indicator increases the spread between the first and third portfolios, mainly due to the reduction in the return of the third portfolio. Okay, so let's dive a little deeper in here, looking at section 4.2, the decomposition of portfolio performance based on bull and bear market periods. And so it's clear from the previous two tables that investing in the top DEA quantile portfolios yields the best results. But now the authors want to split the sample period into bear and bull markets to see if there's a difference in the returns. And so to determine whether we're in a bull or a bear market state or regime, they use a 25% filter. If they're 25% above the latest trough, then they're in a bull market, and vice versa for a bearish market. And so doing that, they find that 145 of the months are in a bullish market, and that's over 5 different periods. And so the remaining months are in a bearish period, and that gives them 47 months total. So 145 months are bullish and 47 are bearish. Okay, so let's go back up here to tables 3 and 4. Okay, so the way this is set up is we'll have to jump around a little bit to analyze, but this first table is, I guess we could say, is the bullish table. It shows, this is equivalent to table 1 in previous sections, and for the bullish regime, and this panel B down here is equivalent to the table 2 above, where it's got the factor based returns. Panel A is shows the returns and the risk based from table 1. So these two tables are just for the bullish regime. And down below will be table 4, which is the bearish periods, with this one being equivalent to table 1, with the returns and volatility and adjusted risk-adjusted returns, and panel B, which is equivalent to table 2 with the factors. Now let's get into comparing table 3, which is the bullish case, and table 4, which is the bearish case. Okay, let's go back up to the bullish table. The first thing to note is that in the portfolios where we're using only value criteria, for instance the book to price and the dividend yield and all that, the difference between the first portfolio and the third and the second is negligible. However, when we add in the momentum indicator to the formation criteria, we get a significant difference between the top portfolio and the third one. And this is across all of the different formation criteria. Although you do note that for the value only criteria, the volatility for the top portfolio is a lot lower than the third portfolio. This difference is a lot smaller once you add in momentum. And you can see that the outperformance of the first portfolio over the third one in each of these cases is significant at the 10% level. In some cases, very highly significant, especially when you add momentum. This is the case also for on the two-factor model, there and there, across all criteria. However, the value-only criteria are not significant. We're looking at the differences of the risk-adjusted returns. So this one and this one are insignificant differences. Now let's take a look at what happens during bearish periods on table 4. So looking at this, we can already see that the top portfolios are during bear markets are significantly higher returns than the bottom portfolios, in contrast to the way that the bull market portfolios were a lot closer of a difference. The volatility of the top portfolios are also a lot lower than those of the third. So it's actually an increase in return and a decrease in the volatility to result in significantly higher Sharpe ratios, albeit they're negative because this is a bull market or bear market. And you'll note that adding momentum to the outputs does not significantly alter the difference between the first portfolios and the third portfolios. For instance, the difference here between 1 and 3 is about the same as portfolio 1 and 3 when momentum is added. And this kind of falls in line with historical studies that find that momentum is very regime-based when its additive properties to return are included. So if you'll remember from the bullish case above in table 3, adding momentum significantly increased the difference between portfolio 1 and 3. But here in a bearish case, it doesn't really have that much effect at all. This has been attributed in other studies to be caused by market sentiment. So in a bullish market, investors are more confident in momentum stocks, whereas in a bearish market, the sentiment is lower and momentum stocks aren't given as a high demand. And so looking over here at the significance attributes, you can see that the difference between portfolio 1 and portfolio 3's return is highly significant. Also 1 and 2 in most cases. However, going down to the two-factor alpha model with the market beta and the size beta, we see that the spread between the portfolios is not significant at all. This is in spite of the fact that the spreads between the top portfolio and the third portfolio are very high. And it looks like the significance of the small factor is highly significant. So we could say that the size factor contributes to the return in the top two portfolios, but not the third. However, if you remember in the bullish case, the size factor is highly significant in every one of the quantiles. However, we find that the beta amount, even though it's significant, it doesn't really have a trend where small or large companies provide a differing return amount. So see here, the smaller companies have a higher return. However, different cases have different amounts of that return, whereas this larger company has a return that's about the same as the smaller company portfolios. But to sum things up, the returns and the normal returns, as well as the risk-adjusted returns of the first portfolio, in almost all cases, significantly outperform the third portfolio in the DEA process. And also interesting to note in Table 4, the bottom portfolio, another thing to note is that the top quantile portfolios lose less of their return from bull market to bear market. So let's see, 33% return versus negative 22. So that's about 50 percentage points. As portfolio 3 goes from negative 41, negative 32. So that's about 70 percentage points. So we could say that portfolio 1 is less risky during a bear market than is portfolio 3. And all of these findings we've just discussed and gone over are similar to findings of other papers previously. All those use different inputs and outputs. The premise and the results are still pretty much the same. Okay, now let's conclude on what all of this means. So the authors use the DEA approach for utilizing both the value and the momentum indicators when selecting portfolios. Using the Finnish stock market over the 94 to 2010 period, they put the stocks into 3 quantile portfolios based on the DEA efficiency scores. And each of the portfolios was compared based on their nominal returns as well as risk-adjusted returns. And to conclude on the results, the top portfolios, those that can be characterized as value and winner momentum portfolios, significantly outperformed the glamour, which would be the growth portfolios, opposite of value, and the negative momentum or the loser portfolios across all of the metrics that were used. And the addition of momentum into the DEA variables improves the returns slightly. So we could conclude that the DEA approach seems to be a good method of portfolio formation because the top ranked portfolios according to the DEA significantly outperform the bottom portfolios, and in most cases the middle portfolios, as well as the market portfolio. And before now, it's not expected that this significant difference in the returns has been found in other studies. And continuing on with this, and comparing the bullish and the bearish cases, it can be found that the top quantile DEA portfolios don't lose as much of their value during bear markets as the bottom portfolios. And so there's a lot of other avenues that this research could take. So since it was found that the different portfolio formation criteria on the different methods didn't really change the returns all that much, the authors think it would be interesting to see how the DEA could stack up to other multi-criteria methodologies, for instance, those suggested by others. Also, the Finnish stock market didn't provide a very large sample of data to use, so they suggest maybe the DEA approach could be used to analyze larger markets. Also, different combinations of inputs and output variables in the DEA calculation could help understand which variables work better than others in combination.